Okay, guys, this is episode number 36, and today we're talking about, if you watched yesterday's episode, we were talking about Credit Suisse and UBS buying Credit Suisse. And today we're going to talk about the Fed, which is our Federal Reserve and our central bank here. And we're also going to be talking about the rates that should be coming out this Wednesday, if they're going to be increasing the federal prime rate. Which people are speculating all over the place right now. But before we get started, I would love for you guys to go ahead and subscribe to the video below. We have a bunch of topics to talk about. We talk about MMA, we talk about geopolitics, we talk about finance here, we talk about cryptocurrency, farming, religion, all different kinds, men's health, all different kinds of things. So if you would go ahead and subscribe below, watch some other videos after this one. This one's going to be interesting also because we're talking about the Fed and the federal interest rates that are going to be maybe or maybe not hiked tomorrow. So let's get right into that. The Fed has meetings. I think it's every like 6 to 8 weeks or so. And in our last meeting, I was not there, but in the last meeting of the Fed, the FOMC meeting, we saw an increase of 25 basis points, which is 0.25% of the Fed prime rate. And that controls a lot, that Fed rate controls a lot of the banking sector, credit sector, when it comes to what the lowest rates that they can provide to customers for. So the bank makes a margin of profit in between what they're getting their money for and what they're providing to the customer. And with all these banking fiascos, crises that are happening in the past 2 weeks, I would say, for instance, Credit Suisse, which we talked about in the last video, check that out. We also had Silicon Valley Bank in, I believe it's San Francisco, near San Francisco, that went out of business. Signature Bank went out of business, which is in New York. First Republic is going out of business right now, which I believe is, I'm not even going to speculate where that is. Regardless, regional banks across the country are going under. The second biggest bank in Europe is going under, Credit Suisse, being bought out by UBS for $3.3 billion. And so we and the Fed, we as a country and the Fed, are in a situation now where we are caught between a unstoppable force and an immovable object. And what do I mean by that? Okay, so here, let me lay this out for you. So, as the whole point of raising these interest rates is to slow down the economy and slow down spending, basically. Our economy has run hot for the past, since the financial crisis, basically 2011, when it finally, teetered off and we started to get back to positive GDP growth. And we continued positive GDP growth through the largest pandemic that we know of in human history, COVID-19, that happened in 2020. And our solution to that pandemic and the tightening of our economy because the government shut it down, which we're not going to get into that. The government shut down the entire economy, the supply chain, people's lives, yada, yada, yada. And instead of having a recession or not shutting down the economy and saving jobs and people's lives and all different kinds of things, we decided to pump $3, $4, $5 trillion into the economy of made up, absolutely fictional money that is based on nothing and is backed by nothing, in order to pay for the PPP loan, which is the payroll protection loan for small businesses and large businesses, for extra unemployment for people who were out of jobs, who needed an extra boost in the furlough time that they were furloughed during the COVID-19 pandemic. And we continued to pump more and more money into the economy of, once again, made up fake money. And that has caused a massive increase in inflation, up to 6-something% at the top, 6.9-something% at the top. And to be quite honest with you, I don't believe those numbers anyway. I think it's probably a lot higher than that. But we made up all this fake money, we pumped it into the economy, and now we have a problem where people are pulling their money out of the economy because they know that stuff is going down. And the banking crisis is happening because of that. People realize that the banks are not trustworthy and are totally taking your money and just like gambling on it, basically going to Vegas and throwing everything on black in roulette and just kind of gambling with everything. And now the chickens are coming to roost, and the inflation is going through the roof. And the only way that the Fed has to combat that kind of inflation is to raise those interest rates and reduce the money supply. And the money supply is the amount of free capital that's in the market that is being churned around, and a lot of it's tied up in the real estate market and in cars and loans, business loans, credit, things like that. And as you raise the interest rates, it becomes less and less attractive to a consumer to borrow because the interest rate is so high. And that's the goal, is to slow down the economy and to go into a recession, which hurts small business, which hurts big business, which hurts everybody. And at that point, because of that cooling, inflation is supposed to go down, meaning that the price of goods should go down because demand, will go down because there's less money spent on things that people don't need, and they're kind of buckling down and saving their money. That's the goal. Okay. So the situation that we have now is that we have run hot in the economy for 10 plus years. We pumped a whole bunch of money into the economy, which caused ridiculous inflation. And now we have a situation in the banking sector where these banks have never experienced interest rate hikes like this, where and you can look at some of these charts. The step chart for how fast interest rates have been raised is unbelievable. It is quicker and more steep than ever before in any other banking crisis we've ever had since they started recording financial data. So we are just cranking away at these financial interest rates. And something finally broke, which was Silicon Valley Bank 2 weeks ago, and Signature Bank, and Credit Suisse. And you can go down a whole list of banks right now that are in serious trouble at the moment. Charles Schwab, which is a brokerage, which is not a bank, is in serious trouble right now, although they do have a lot of capital on hand. And so now we are stuck between a unstoppable force and an immovable object. Because if you go to the FOMC meeting, and we're going to talk about that, which we'll circle back to that. If they raise interest rates, 25 or 50 basis points, which if they do raise interest rates, that's what they'll do. They'll either do 25 or they'll do 50. More banks are going to go under. And these banks are already in trouble. We have like 160 plus banks that are already having liquidity concerns, regional banks that are having liquidity concerns. So these banks, if we have 25 basis points more or 50 basis points more of interest rate on that, that's going to reduce the demand of real estate, of cars, of business loans, of all different kinds of loans. And these banks are not going to have enough money coming in order to justify the money that is going out in deposits, because people are pulling their money out because they realize things are going downhill quickly. Okay, so that's on one side. That's one thing that the Fed has to worry about. Okay, so they raise interest rates, banking crash. Okay, on the other side, you have inflation. If we don't raise interest rates, the money supply, everyone's going to think, oh my God, we're having a positive interest rates. That means it's going to start going down. That means inflation's going to start going down. Everyone starts to spend their money again, and inflation starts to go up again. So we had 6%, something like that on the last CPI, which once again, I don't believe. And so if we don't raise interest rates, or if we start to cut interest rates, the money supply is going to start to go back up again. And then we have hyperinflation. So, and let's go back to the other side, which is the banking crash. If the banking crash happens, we've still pumped all this money into the market now because we have all of these liquidity backstops from Credit Suisse and the Swiss National Bank, and also the liquidity program from the Fed, which I think is like $200 billion, which means we're pumping more money into banks that doesn't exist, that doesn't have any backstop, or that is a backstop that doesn't have anything backing it. So one side is banking crash plus hyperinflation. The other side is just hyperinflation, right? So I don't know which way they're going to go. I don't know which way Jeremy Powell is going to go on this. But to be quite honest with you, either way is bad. Either way is bad, and it's going to be very interesting to see what they're going to do, because it's going to really tear some stuff loose. It's going to tear stuff loose in real estate. It's going to tear stuff loose in your cost of living. It's going to tear stuff loose in just about everything. So we are heading for a financial crisis if we're not already in one or at the start of one. And there's not a whole lot we can do about it. And the terrible Fed policies of this administration and of the Fed and previous administrations who pumped a whole bunch of money into the economy have led us here. So that's my explanation of the Fed meeting and what's happening. And I hope you guys like this video. And on a more positive note, I hope you guys follow my Instagram, which is David Coleman YT. Go follow my Rumble, which is David Coleman 27. My Twitter is Colma63ETH, which I'm more active on there about finance and cryptocurrencies. And I hope you guys really like this video. Subscribe below, and we will talk some more about finance next week. Thanks. Bye.